What if I told you that everything is on the table to kickstart the housing market, including declaring a national housing emergency? Treasury Secretary Scott Bessent said exactly that in a Labor Day interview, and the implications could resuscitate the housing market and the broader economy in 2026. I'm John Cervantes. I manage nuanced investment portfolios for everyday families, and you're watching the Practitioner's Brief. Today, we're deep diving into the housing market and what it could mean for your investments, markets, and the broader economy. So let's get into it. If you've been following the markets, you know that October 2025 was yet another example of the same story. AI stocks leading the way, and the rest of the market kind of ho hum. So, this type of activity is somewhat a reflection of the economy more broadly. While I could cite numerous statistics, we really only need to look at the most recent consumer confidence data from October. And the conference board cited that confidence fell for consumers making less than 75,000 a year, but improved for most of the income groups making more than $75,000 a year, with the largest increase coming from those earning over $200,000 a year. So quite a bit of bifurcation. This is what the Treasury Secretary Bessent highlights in his Labor Day interview with the Washington Examiner when he calls for a new economic paradigm through parallel prosperity. But really, there's a lack of it. And we got asset owners doing incredibly well, while the other half of the country is getting squeezed by higher costs and not really benefiting from a booming stock market. And we've had some recent election results that highlight some Democratic victories where cost of living challenges were cited as the main issue for voters. So we have the midterms approaching. The administration knows this, and it's going to take some time for policy changes to impact voters. So the question becomes, what can be done to improve the financial position of most Americans? And the answer is pretty simple, but also incredibly complex to execute. And that's reduce interest rates and unfreeze the housing market. We can look at existing home sales, new home sales, just broader affordability challenges. The housing markets are just stuck. And the primary driver of this is mortgage rates. And it's not just because they're higher than recent history, it's that we have the biggest gap between the current mortgage rate and the existing outstanding mortgage rate since the VOCA era. And when housing moves, everything moves: retail, banking, core based commodities. And it benefits everyone from professional services to tradesmen. So, how do we get to lower mortgage rates? Well, there's really two key components that are going to help simplify the discussion. First one is the 10-year treasury rate is the base reference point for the 30-year mortgage. And it's been falling, ending October just north of 4%, and there's some indications that it can go lower. Inflation remains range bound, it's moderated significantly, employment trends are weakening, and we've had some recent credit events like the First Brands fiasco that are keeping the bond market on edge. And right or wrong, the administration is also pretty good at getting what it wants, and it wants lower rates. We're going to have a new Fed chair in 2026, and that will likely drive expectations about a lower federal funds rate in the future. All this, I think, keeps the 10-year bias lower, in my opinion. Now, there's some friction, and that friction is the current Fed chair, Powell. He needs to play ball. And on October 29th, he didn't. Following the Fed's decision to cut interest rates by a quarter percentage point, Powell threw cold water on the expectations for a December rate cut. He said there are strongly differing views within the Fed about how to proceed, and that December is far from a foregone conclusion. Well, the markets had already priced in a December cut with over 90% probability before Powell's comments. Afterwards, it dropped to under 60 or 70%. So a requirement for a lower 10-year is going to require Powell to play ball. But here's the thing. Even if the 10-year treasury is at 4%, mortgage rates aren't. They're firmly above 6, and the difference between those two rates is a mortgage rate spread. And this spread compensates investors for the unique interest rate risk of mortgage-related bonds. And post-Great Financial Crisis and during the pandemic, the Fed ran a program called quantitative easing, where a part of this program, they actively purchase mortgage-backed securities. And when the Fed buys mortgage-backed securities, they are price agnostic, buying just simply to compress this spread. But since the inflation spike of 2022, the Fed has switched to quantitative tightening. They stopped buying MBS and starting letting the maturities roll off the balance sheet. The open market has to come in and pick up the slack. And Mr. Market doesn't do anything for free, so the spreads widen. Now, on October 29th, the Fed announced that it's ending its overall balance sheet reduction on December 1st. They'll reinvest all principal payments from maturing mortgage-backed securities back into Treasury bills. That's a big deal. It means they're stopping the shrinking of the balance sheet. But they're not going to start quantitative easing again, and they're not going to be actively buying new mortgage-backed securities. But the Fed could go further. It could start to reinvest mortgage-backed security proceeds back into new securities, or even just begin buying new mortgage-backed securities altogether. This could directly target the mortgage rate in a way that just broad policy rate cuts can't. And remember, there's a wild card. Remember when Bessent said everything is on the table? There's even talk of allowing Fannie Mae and Freddie Mac to purchase their own mortgage-backed securities to control this spread. While it's not standard practice, in fact, it's a little bit controversial, the administration is clearly not afraid of controversial policy. So if you combine a 10-year that's biased to stay around 4% or potentially move lower, you have numerous options to compress the MBS spread, and you have the political will to declare a national housing emergency if needed, which could see standardization of building and zoning regulations, targeted tariff relief on construction materials. You're really starting to see the ingredients necessary to awaken a new housing cycle. But what does this mean for 2026? The AI story is obvious at this point, but markets are cyclical. Capital runs sometimes with its hair on fire to trending opportunities because this time it's the new state of the world forever. And often there's some nuggets of truth to these trends, but let's remember what happened in 2020. As the COVID pandemic drove everyone into their homes, the stay-at-home theme exploded. Market participants chased hot stocks like Zoom and Peloton, extrapolating the current stay-at-home dynamics into perpetuity. And there was even one point where Zoom was valued more than Exxon. This is sometimes why I chuckle when I hear the market called deficient. The lesson here really is extrapolating the current moment into perpetuity is dangerous. At this current moment, it's difficult to see what disrupts the bull market. AI stocks keep going up, the Magnificent Seven continue to dominate, but I do ponder if we can get a handoff or who else can join this party, because at the current tenor, those at the lower end, they're getting their pitchforks ready for the voting booth. They could care less about some of these AI dynamics. So unfreezing the housing market could awaken the S&P 493. So here's the thesis. Unfreezing the housing market can awaken consumers. When you reduce mortgage rates, get the housing market moving again, you reduce interest burden for millions of households. You create jobs in construction, real estate, finance, home improvement, and you just stimulate the lower end consumer. And when I say lower end, I'm not talking about the bottom 10%. I'm talking about the bottom half. This cohort spends, and they spend because they have to. And there's a significant multiplier effect from waking up housing. It trickles down everywhere, from retail and banking down to core commodities. And this is the exact type of economic environment where the broad S&P 493 can benefit. So from a portfolio construction standpoint, this isn't about abandoning the Mag 7. They still may do well, but it's about diversifying, maybe inclusive of, and not just focused on concentrating within these 7 companies. Now, are there consequences to the stimulus? Absolutely, there are. When you lower rates aggressively, when you potentially start to restart mortgage-backed security purchases, when you stimulate housing demand, you do run the risk of reigniting inflation. You risk creating another cycle where the Fed eventually has to return to interest rate hikes. But that's a problem for later. We're going to have to worry about it then. Powell wants to worry about it now, and that is where the tension lies. The administration wants to stimulate the economy heading into the midterms. They want to close this prosperity gap, and they want housing to move. Powell and some Fed officials want to be cautious. They want to avoid mistakes. They want to make sure inflation is truly under control before they start cutting or have an aggressive, accommodative policy. But the Fed is deeply divided. The October 29th vote was a 10-2, where you had one dissent for a larger cut and one dissent for no cut at all. Kind of historical, actually. So it's super messy, it's uncertain. But for me, the direction of travel is clear. Rates need to come down, quantitative tightening is ending, and the pressure to unfreeze the housing market is immense. And so those are real implications for 2026, and we want to skate to where the puck is going. So let's wrap this up. what does this mean for 2026? The AI story continues, but we could be approaching a handoff. Unfreezing the housing market could create a powerful multiplier effect for the broader economy, and this could re-engage the S&P 493. Their growth rates are converging with the Magnificent Seven, so there's real implications here. But the risk our inflation could reignite, and the big question for you as an investor is, are you positioned for this potential rotation? Are you too concentrated in AI and mega cap technology? Do you have exposure to housing sensitive sectors like home builders, banks, retail, commodities? Are you thinking about the benefits of a broader economic recovery? These are questions that I'm asking and that you need to be asking as we head into 2026. If you found this video helpful, please hit the like button and subscribe to Practitioner's Brief. I publish insights about portfolio strategy and financial planning content pretty regularly. And if you're a family in the San Antonio or Austin area, feel free to reach out. Thanks for watching.